Oliver, Standard Chartered shares were up about 2% today after it brought out first half results, and these were the maiden results of Bill Winters as the newish CEO. He seemed to strike a slight change of emphasis, talking about returns over growth. Is that such a big change?
Yeah, it seems to be for Standard Chartered. In the past, this is a bank that's always talked about growth and whether it can achieve double-digit growth, and it's been putting a lot of money into its operations, especially in Asia, and growth has really been the emphasis. Now with the new chief executive, Bill Winters, really talking about returns, and well he might, because the returns in the first half weren't great. It produced a return on equity of 5%, which is really pretty poor. Over the past few years, it has managed to get above the 10% line that Mr. Winters says is the minimum that investors require.
Okay, so let's drill down into the numbers. What's been holding back those returns?
So the big problem this time around was a big jump in the impairment charge. This is the charge made for bad loans. That almost doubled over the same period last year. And the difficult thing really for investors is to divine how much that is because of worsening conditions in the first half of the year and how much it's a sort of cleansing operation by Mr. Winters, how much he's coming into the bank and saying, right, I want to write things down as much as I can to provide myself with a lower base to start from. So it's not clear which of those two is really going on, but that really is what dragged the return on equity down to 5%.
Okay, so he's resisted the temptation to do what we call kitchen sinking, throwing all the stuff in, but he's also resisted the temptation to do a cleansing capital raise. Is that a surprise?
Well, some people thought he might have done one. That said, early August is not seen as an ideal time to go to shareholders looking for equity, given that a lot of the shareholders will be on the beach. It's not ruled it out, though, so there may be a capital increase down the line. He's doing a new strategic plan. He'll report on that later this year, which I guess is when he'll tell us whether he needs more equity or not. The question really is how much this is down to him, how much the internal actions he can take can improve the bank's returns, or whether, in fact, the group's markets, particularly in India and perhaps in China, are deteriorating to the extent that there's more impairment charges and hence more pressure on the capital levels. So he's given himself some wiggle room. One thing he has done today is to halve the dividend for the half year. So that is very sensible if you think of raising equity later in the year.
So he has done the first sort of 101 self-help thing, which is sacrifice the dividend. That hasn't gone down too badly by the look of it, but obviously, as you say, we'll have to wait for his strategy day later in the year. Thanks very much, Oliver.